I think that we were growing over 3% in an economy with a unemployment rate of 3.7%, and that was unsustainable. We were going to end the bull, we were going to end the recovery if we continued to do that, because the Fed and bond vigilantes would have to raise rates to kill them off. And what I think we've done here is we've created a slowdown in the economy. I think we're going to slow below 2% over the next 4 quarters into 2019, and that might just be enough to eliminate stag and put a pause button on the Fed and bond vigilantes, and I think allow one more run here in this bull market. I think I don't know where the bottom is here, and it's going to be volatile for a little while now, but I think it's time to lean back towards more aggressive stance in your equity portfolio. And I think at least, I don't know if we'll set new highs than we've already seen, but I think we're going to have a pretty good 2019 here finally. I think we created some panic. We've massively revalued things. We've taken the multiple trailing earnings in the S&P from 23.5 in January to about 16 times. That's from upper quintile to lower quintile valuation in a year over the last 30 years since 1990. We've created some panic, and I think pretty soon we're going to have a definitive view that the Fed's done raising rates and maybe even will cut rates in 2019.
You know, Paulsen, if you were like Joe Granville, or if you had like investment groupies, this is a huge change for you, and you know, you're on quite frequently, and this is I didn't know you were going to necessarily be this sure about what you're saying. When was the last time you were this bullish, Jim? It's probably 2.5 years, 3 years.
I'm never sure, Joe.
Well, I remember,
sure.
and you've been, and it hasn't been wrong where you were, and I don't know if you got there with the right rationale necessarily, because I'm still not sure about commodity inflation that you've always been worried about. But you haven't been this bullish in at least a couple of years, I think. And this is the first time you're telling anyone, or did you put out something on Leuthold?
Well, I haven't written anything yet. I got a piece coming out here next week that will change it. But I think that, you know, I guess I was bullish last in late 2017, Joe, and kind of been more cautious since, but I could be wrong. Maybe this is a bear market and we got further to go. I think the key issue is, do we recess or not? And I just think we don't recess. I just don't see that this year. I think we've got a great fear of it, and with corporate bond spreads blowing out, the yield curve flat, there's people getting more and more concerned. But I think we're going to skip a recession, at least in the foreseeable future.
And have another leg,
and if
another
we don't
bull
recess, then we have another leg, I think, here left, and we ought to maybe get more aggressive again for the first time in a while.
Okay, but I'm going to get to Gene, and I'm sorry to take this long, but what about copper and oil, Jim, in terms of your commodity inflation concerns? Or did the recession concerns
They'll come back, Joe.
Huh? They're going to come back.
If the recovery doesn't end, then we're still at 3.7% unemployment, and eventually, if we continue to grow, we're going to raise them. And the key issue this year, I think is going to happen, is the dollar is going to go weak. That's what killed off commodities in 2018, was the 10% rise in the dollar. If that breaks down again, I think we'll revive gold, or not gold, but we'll revive oil and other commodity prices again. And I think cyclical commodity stocks might do very well this year in 2019 if that dollar breaks again, as I guess.
Where are you on the possibility of a recession, Gene? I mean, I'm seeing here that you're saying we overreacted, the market did, to recession fears. But are you looking for earnings growth? Will there be an earnings recession in 2019 or no?
Definitely not. So we're not as bullish as James is, but think about this. We're cautiously optimistic.
He's never bullish. Are you cautiously optimistic? I can't believe you're using it. I mean, can't you do it optimistically cautious or something? I mean, change it up.
No, Joe, we debated this last time, but we're cautiously optimistic. Think about this. Okay. Stocks are driven by two main factors. Number one, fundamentals. Number two, valuations. Look at fundamentals. We are, earnings are going to be up this year about 20%. Next year, earnings about 7.9% according to FactSet. Revenue growth up 5.3%. Let's say there's some noise in the earnings data, maybe 6 to 8%. Look at the economy from a fundamental standpoint. GDP is up 3%, 50-year low unemployment. You look at retail sales. Yesterday, retail sales came in at a 6-year high. Shifting to valuations, though, and we all know our old friend Louis Druckheiser said, listen, trees don't grow to the sky. So stocks were due for a pullback. Think about, we had Washington, we had Europe, we had concerns about the Fed, we had lots of issues out there. Stocks were due for a breather. We do believe those stocks have pulled back too far. Right now, the PE ratio on the S&P and forward earnings is about 14. That's a 5-year low. And think about this, Bob Pisani was on CNBC yesterday, and we echo his same thoughts. Listen, the market is pricing in no to negative earnings growth and a recession for 2019. And we don't believe it. We think a recession may be 2020, but 2019. You think about it, we just finished Christmas. The discussion a year ago for Christmas was Bitcoin going to 0 or 100,000? Now the discussion around Christmas table, at my Christmas table, was when will the recession start in 2019? We don't see a recession in 2019. We see maybe in 2020. 2019, the Congressional Budget Office, the consensus is saying 2 to 2.4% GDP growth. We're right there. We think
but Gene, a recession in 2020 would still justify this market pullback. It's more a case of whether or not we could miss GDP growth by 0.5% or not next year.
True, but that's why our market expectations for next year are mid to low single digits. We're thinking maybe 4-5% in returns for next year, but it'll be front-end loaded. We do think returns will be strong for the first half of next year, but then as the market prices in, an increased likelihood of a recession in 2020, it will be weak in the second half of next year.